Hello, everyone. It is Thursday, October 13th. We'll be talking with Katie Stockton from Fairlead Strategies. Has a couple charts to hopefully help us make sense of this crazy market, big outside day for the major averages. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining me every weekday after the close as we try desperately to make sense of the movements in the markets. Today was a crazy day. That is the adjective I will use to describe this. We're going to look at what today's trading means relative to the long term. And the answer is big short-term bounce, big short-term rally. The question is that a long-term thing or just a short-term thing as the S&P bounces off of 3,500? We'll look at the charts. My guest today, Katie Stockton, should be helpful in helping us make sense of that as well. Speaking of our guests, coming up next week, we have three good guests lined up for you. On Tuesday, the 18th, we have Dana Lyons from J. Lyons Fund Management. He's the editor of the Lyons Share Report, always a really good guest. On Wednesday, the 19th, joining us for the first time, Hema Reddy. Hema is an author, educator, trader, wrote a book on GAN analysis. So it'll be interesting because that's all about the relationship between price and time. We'll see what her toolkit is telling her about the current market environment. Jeff Hughes from JWH Investments will be joining us next Thursday on the 20th. Also, I will be doing my next webinar with market misbehavior called the Market Bottom Checklist Revisited. Back in June, we did a free webcast called the Market Bottom Checklist. I shared 10 data points I was following to track a market bottom. Worked pretty well June, July, August. Now we're back retesting the lows today, undercutting those lows. We'll revisit that list and also related to the seasonal trends in November and December. Go to marketmisbehavior.com/October to sign up for that free upcoming webinar. Let's continue on our show today with the market recap. Let's focus on how the charts have evolved from yesterday to today. And I tell you, evolved is the way I would describe most of these charts. It's so interesting early in the morning, right? When I'm first firing up the laptop, looking at the market, seeing what's going on. We opened low, right? And the S&P opened right at 3,500. You can see yesterday's trading session looks relatively muted versus what we saw today. We opened around 3,500. By the end of the day, we almost got to 3,700. Talk about a swing from weakness to strength, making a new 52-week low intraday before, essentially driving, 2.5% plus to the upside. The S&P 500 up 2.6%, led by energy and financials, but technology was not far behind today. Mid caps and small caps both up as well, over 2%, but not as much as the S&P. The Dow was up almost 3% today. The VIX still above 32, but pulling off of the extreme high we saw earlier this week, where it was pushing up toward the mid 30s. We're now back to around 32, so still elevated relative to the trends in 2022, but coming off just a bit from what we saw yesterday. Looking elsewhere at the other asset classes here, we have interest rates pushing higher, although it was choppy and almost went negative. Touched 390 on the 10-year yield. By the end, bounced about a bit higher to 395. Earlier in the day, 10-year yields were up above 4%. That 4% level has been sort of a ceiling, right? An unofficial ceiling for the 10-year. Long bond yield has gone a little bit above there. But 10 years sort of stalled out at 4%. Happened again today. Again, bouncing off 390 to around 395 through the course of the day. The dollar pulling off today, and that weaker dollar is what's giving room for equities and other risk assets to push to the upside. Gold and silver both in the red, although the GLD was a crazy, again, just a strange look to the charts, to be honest, after today's trading. This is a weird session. Gold and silver both down today. The rest of the commodity ETFs that we track all in the positive. Cryptocurrencies pretty choppy and net negative. Bitcoin has actually been pounding back to the upside along with Ether. We're looking at the little preview chart of Ethereum yesterday afternoon. Was just below 1,300, kind of pushed up against that 1,300 level for much of yesterday. Today, actually falling off a cliff, almost hitting 1,200 before rebounding all the way back up to almost getting back to 1,300. 1,300 is a level we've repeated a number of times. For Bitcoin, it's 20,000. Nice bounces off of the lows for both, but still below those key levels of resistance. We'll look at a chart of the S&P 500. I know reviewing Katie's charts before we got started today, I know we'll be looking at the S&P, so I don't want to go too deep into this, but her chart is looking a little different than mine in terms of the indicators she's using, which is why I'm interested to hear how she is sort of characterizing this short-term bounce that we saw today. So the way you would describe today, it depends on your methodology. A bullish outside day, which is what the bar chart would sort of say. If we zoom in a little bit, let's just make it like a 3-month chart. A bullish outside day is where you have a down day followed by an up day, and it's a wider range on day 2. So it's an outside day because basically the range has expanded from yesterday's high-low range to today's high-low range. Opening lower, closing stronger, sort of the classic, the classic look. So what's interesting is when you see the bounce today, you now have a bullish momentum divergence, right? With RSI, lower lows from late September to mid-October here on a price basis, but higher lows with RSI. It's sort of setting up with the bullish outside day and the bullish momentum reversal, potentially telling you there's a short-term bounce here impending. Now, the other thing we can look at is from candle charts. If you're a candle aficionado, you technically call this a bullish engulfing pattern. Now, some of these look more classic than others, and I'm highlighting this on the S&P, but there are very few things I feel like that did not have a bullish engulfing pattern. A lot of individual names. I was highlighting some of those for my Market Misbehavior Premium members. Did a market update earlier today. We were going through a lot of individual charts where we saw some of those, and it's really helpful because it tells you that the short-term supply demand has shifted, right? There's short-term, a shift in sentiment from negative yesterday to more positive today. Usually suggests a short-term rally from here. It's telling you the next, at least the next couple bars, most likely higher rather than lower, which tells me 3,800 is a really important level to watch. That was the swing high from about a week and a half ago. What would tell you that that is wrong? Well, we violate the lower end of this 2-candle pattern, which means we get below 3,500, and it tells you all bets are off. This is still very much in a downtrend. Now, elsewhere, just to finish off our market recap here before we take a brief break, I wanted to look at the sectors and maybe some of the individual names on the move. When you look at sectors, energy and financials both up over 4% today. So it is worth noting that out of the top 5 sectors today, all up over 2.5%. Only one of those, technology, what I characterize as a growth sector. The rest really all defensive and or value sectors. Energy and financials obviously at the top of the list. When I think about a rising rate environment, when I think about value over growth, I immediately think about things like energy and financials, materials, industrials. Those are the places where you'd most likely assume there would be some strength as a result of that. Certainly the case today. So nice move higher, but it wasn't just all the FANG sectors at the top. It was energy and financials, number 1 and number 2. What underperformed as the market's going higher? All the consumer stuff, right? So consumer discretionary up just over 1%, consumer staples up 1.6%, followed by REITs, which has been an underperforming sector for sure here recently, particularly after the August peak for the S&P 500 and for the NASDAQ. So it's interesting that both of the consumer sectors at the bottom, when Tom Bowley was in town for ChartCon 2022 over the weekend, had a lot of fun talking with Tom. He actually stayed over on Monday so we could talk to him about some specials we're thinking about doing and other things we will be doing together here very soon. He and I have sort of gone back and forth on the consumer ratio, what I call the offense versus defensive ratio. It's interesting that on a day like this, which is the market reversing dramatically and going to the upside, both the consumer sectors are kind of in lockstep, right? No real differentiation between the two of them, especially that they're at the bottom of the list today. Just to finish off here, our market recap very briefly, I want to highlight a lot of financials moving to the upside. I mentioned sort of these bullish engulfing patterns, and you'll see that on KeyCorp, you'll see it on BlackRock, you'll see it on a number of other ones, similar to what we saw with the S&P 500. At the very least, a bullish outside day. I think it's worth keeping these into context, though. And as we head to the break, it's always important to differentiate the short term to the long term. So certainly a short term bounce, 100%. Could this be the beginning of everything going and testing a new 52-week high? It absolutely could. That is theoretically possible. However, I would argue the market still has a lot to prove before I would feel very confident that that is the likely outcome. Stocks like KeyCorp, while bouncing off of the lows, let's not, mince words. Yesterday was a 52-week closing low, and earlier today, it made a new 52-week low intraday. So we are still very close to new lows. A lot of these stocks made new lows today. While there is short-term upside sentiment, let's not forget that the long-term trend, I would argue, for the most part, still defined as downwards. Let's take a quick commercial break. We'll be back with Katie Stockton. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest, Katie Stockton. First off, we welcome your questions. We'll do a mailbag segment on tomorrow's show. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. It is completely free and features some fantastic guest discussions, interviews, special events like Larry Williams' Market Outlook, which he just put out yesterday as a preview. I think it's entitled Up, Up, and Away. So you get a sense of where Larry's head is at with the market bouncing off of new lows. But a lot of great guest interviews from our fantastic group of StockCharts contributors. Go to StockChartsTV.com. We're on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Katie Stockton. Katie is the founder of Fairlead Strategies, also a fund manager of the TAC ETF. Katie, great to see you. Welcome back.
You too, Dave. Good to see you too.
So a fascinating day to have you on the show. I'm very keen on hearing your take on an abrupt reversal, is how I would describe it, after opening at a new low for the year, but then closing above the last couple of days. We're starting with your chart of the S&P. Talk us through what you're seeing here.
Well, I mean, first and foremost, as you mentioned earlier, it's an outside up day here. So that's when that sort of wide range encompasses the previous days and you see a very strong close. And it does often see immediate upside follow through. So short term, there's some improvement off of today's action. It also occurred upon a test of support, which we'd been watching for right around 35.05 for the S&P 500. That level was based on a 50% retracement of the uptrend going back to the COVID low. And it's not a highly important level. It's more of an interim level, but it would be sort of a natural staging ground, in our opinion, for some kind of more intermediate term relief rally. By intermediate term, we're talking weeks, not months, but something that would be aligned with the seasonal influences that come into play now here in the second half of October.
Right, we're sort of entering into that seasonally strongest part of the year, which is something certainly to keep in mind. Your second chart, by the way, Katie, is looking at Bitcoin. Bitcoin certainly has been a difficult chart. Most of the cryptocurrencies have been struggling. Are there signs of optimism that you're seeing in crypto land?
Well, this morning we saw it trading lower, and that was a little bit of an indication of the knee-jerk lower that we saw in the equity market today, and yet now it's trading up. So some intraday volatility here, and it's coming right around some very key long-term support, again, based on a Fibonacci retracement level of roughly 18,300. It's a key level, and it absolutely needs to hold, especially if it's on a consecutive weekly closing basis in our work. And for that reason, if we don't see it hold, the next support, unfortunately, is below 13,900, and that's based on a secondary Fibonacci retracement level. So we have a lot of room to secondary support, and yet near term, it's somewhat coiled up. You see how it's really seen sort of compression. The volatility obviously picked up a bit today. And so we're watching the boundaries of this sort of tight consolidation phase, which has the long-term support 18.3, and then of course, both the cloud model, which you see as a shaded area on the chart, and then also the 50-day moving average kind of create the upper boundary of that coiled up formation. Coils, like in and of themselves, they don't give you a directional bias, but you do often assume that they're going to be resolved in the direction of the prevailing trend. We'll be respectful of a breakout if it does occur, but it's certainly challenged here.
The next chart is looking at the VIX. Volatility has been, pretty elevated. You have a really interesting analog between where we're at now and a couple of years ago. Can you talk us through this comparison?
Yeah, it's really a few years ago, more than a decade now, looking back to the 2008 bear market cycle. And we're not really huge on analogs. I know there's always something different this time, right? But the comparison does have sort of an eerie takeaway in that the range that's been prevalent in the VIX, and that range, by the way, persisted even with today's volatility. The VIX was really sort of depressed with that in mind, still well below that sort of 35 resistance level that you see. That range ultimately in 2008 did resolve after a period of sort of lower volatility for a few weeks. It gave way to a pretty big 80, 90 volatility spike on the VIX. And of course, that showed fear increasing to the point at which we finally got like the end of the bear market cycle. But the comparison does suggest that we've got a ways to go, perhaps, until we see some kind of culmination, at least as it pertains to this metric. We don't think we need to see it get to 80, 90 necessarily, but I certainly wouldn't rule out maybe a 50 reading on the VIX if and when we do clear that 35. First, though, the initial more short-term takeaway from this comparison would be that you see a little contraction or greater contraction in volatility here in the coming weeks.
We only have about a minute left, Katie, but I do want to address your final chart. We had Larry Williams in our office over the weekend, and we were talking about Tom DeMark, and you're bringing up one of his indicators. Talk about what this tells you about, the breadth of the market here.
Well, right. It is essentially a breadth takeaway that we're trying to derive from Tom DeMark's wonderful indicators that are designed for identifying trend exhaustion. These ones are daily signals that we derive from both the TD sequential and TD combo models for those that track them within the S&P 500. And we basically just tallied them up. And we like to watch this measure over history for when it becomes sort of high frequency like we've had of late. And it has us paying attention for sure. And it does suggest that we could see momentum here improve behind the S&P 500. Sort of that short to intermediate term low would be supported by this spike up in the DeMark buy signals that we've seen.
Katie, it's awesome to see you. Thanks for bringing some charts along with you. Say hi to the East Coast for us, and we'll talk to you again soon, all right?
I sure will. Take care.
It's Katie Stockton. Katie's the founder of Fairlead Strategies in Connecticut. I've known Katie for a number of years. She's a fantastic analyst. And I love how she was talking through, number one, how calmly she was addressing an incredibly volatile day. But I think that's what you need to do in this industry is get some perspective. That last chart, by the way, is identifying the number of stocks, with how I would describe it as trend exhaustion, right? Stocks that have been in a downtrend that the DeMark model is indicating is most likely at an exhaustion point, pretty high and higher than we saw in March 2020 by Katie's work. Great take there by Katie Stockton at Fairlead Strategies. Let's continue on our show today with Getting Sentimental. Let's look at the sentiment indicators, which we like to update usually once a week around a Thursday. Pay attention to what sentiment is telling us. We'll look at three different things. We talked about the VIX with Katie, so I'm just going to spend a minute there, and then we'll continue on looking at survey data. We'll finish up looking at the put-call ratios. So to start off with, my chart of the VIX really is meant to illustrate sort of these different regimes. I love Katie's analog comparing where we're at now with the VIX with that 2007, 2008 period, right? That's where the market topped out in 2007. 2008 was kind of that rollover, really accelerating to the downside to the eventual low, the first quarter of 2009. But in 2007, 2008, you had a very similar look to the VIX, right? And sort of in a similar range as well. In 2022, if all you did was sell when the VIX hits 20 and buy the S&P when the VIX hits 30, 35, you did pretty well. And you essentially captured all the major turning points in 2022. It's worked really well until recently, right? And we saw the VIX spike above 30 in late September. We had a brief bounce of a couple days, but then as we know, once again, going into this week, making a new low. And Friday, as we're in the middle of ChartCon, the S&P is sort of raging to the downside as we're trying to do all these panels talking about risk management. That was a lot of fun, by the way, trying to negotiate that day with all of our fantastic contributors. But I think it was a great illustration of how professionals kind of navigate these kind of uncertain times. So my comments, my discussions with a lot of people in the industry, very similar to what we had there with Katie. It's a lot of not necessarily disbelief, but just questioning the what's the word? Sanity of the market, I guess is how I would describe it, with a huge swing intraday, wide volatility. That kind of move is not going to make the VIX go down very much. I mean, they're not looking at the same data. The VIX is looking at the options market, but if that's the kind of volatility we have going on, most likely that volatility is being reflected in the options market as well. So the VIX still above 30. When the VIX gets out of that 30 range, that's when we can talk about the market potentially bottoming out, not just on a one-day thing, but something more significant. Survey data, really interesting. And I'd be very curious if the AAII survey was open today for this week, if the needle would have moved very quickly because of today's intraday move. It certainly is causing me to think much less on the press the downside mentality and much more on the, there's a brief upswing here. Again, depending on your time frame, that would depend on or be a big factor on how you should, I think, be trading around this kind of move. If you're a long-term investor, I think you're still thinking of the market as in a downtrend until there's a broader rotation, not just on a one-day basis, but bigger changes in a lot of the key charts that we've been discussing, particularly measures of market breadth. When we look at sentiment, you can see not much change from last week to this week in terms of the level of bearishness. Still over 50%, about 56% bears in this week's survey, which is a pretty big number. That's, again, one of the largest numbers of largest readings for the bearish indicator that we can see going back in the deep history of the indicator, which goes back for decades. Only 20% bulls. And just if you look back at the last 5 years, you can see this is one of the lowest readings that we've seen in the last 5 years. And again, one of the highest readings that we've seen in bearishness. So this one-day move aside, up until today, really a lot of bearish sentiment from investors, sort of an acceptance phase, I guess, if you will, on the extent of this downside that we've been experiencing. The spread between bulls and bears is widened out a little bit. It's around 35, 36%, which is again one of the larger readings that we've seen. The name exposure index, pretty interesting. This is looking at the National Association of Active Investment Managers. They survey their members and ask what your exposure is to the equity markets. And you can say, how long you can be 100, 200% long, 100, 200% short. And then they aggregate all those into a composite number, which is what we receive. As of this today's close, it's just below 20% exposure to equities. If you think about the normal allocation to equities, around 60, 70%, it's about 70%, I think, looking at the actual data. We're pretty low. And if you look at where we've been over the last 6 months, overall, with an exception of going to the August high, for the rest of that period, it's been very, very low. Not the lowest readings in history. We have gone below zero on a small number of occurrences, but overall, certainly suggesting money managers, particularly in this survey, are underweight stocks and not really pressing any sort of long side. Again, we'll see what happens if today manifests into something further. What I always say when there's a big move in the market is look for follow through. I think tomorrow becomes very important. Today was a big move, opening low, trading and selling, closing high. Do we get a follow through tomorrow, right? And Tom DeMark, whose work we alluded to earlier, was always big on follow through days. With Larry Williams, we've talked about follow through days, very big on individual days, and whether you get that sort of additional follow through, which shows you that it's not just a one-off thing, it's more of a lasting trend in the markets. That's why tomorrow may be key. When you look at the RIDEX flows, this is essentially looking within the RIDEX family of funds. Are investors more on the offense, things like traditional index funds or sector funds, versus defense, things like money markets or cash-like types of funds, fairly defensive. And overall, you can see that investors in the RIDEX family are fairly defensively positioned. The higher the number, and I've plotted this inversely because it makes a little more sense visually, the higher the number here, the bigger the red bars, the more defensively investors are positioned. If you look from the fourth quarter of 2021 to where we are at now, starting the fourth quarter of 2022, you can see we've gone, investors in these funds have gone from very bullishly positioned to very bearishly positioned at this point. Similar positioning to where we saw at the low in 2020 and the low in 2018. Nowhere near the positioning that you saw at the end of 2015-16, which is where investors got a lot more defensive even than they are right now. It's really interesting if you were a part of ChartCon, and I hope you didn't miss it. It was a really great event. I guarantee we will be doing more cool events like that. We're gonna take some breaths after that one, because that was a lot of work and a lot of effort by the team, the StockCharts TV team, which did a fantastic job, I thought, producing a high quality presentation for all of us. But I was struck by Linda Raschke's keynote presentation, where she talked all about a number of different things, but in particularly cited the put call ratio. As a matter of fact, in her contribution to the market survival kit, which we released just yesterday for all of our members that attended ChartCon 2022, we released the market survival kit, which featured charts from a number of our presenters, things that they would recommend keeping an eye on to make sense of these markets. This is kind of similar. This chart here is similar to the one that she contributed. It's based on the equity-only put-call ratio. She had some different indicators, different look to it, but this is basically what she was talking about. Her comment was, particularly for the intermediate term, it's really important to look at the put-call ratio, because it's looking at the options market, looking at positioning in the options market, and using that to make some inferences really about the condition of the equity markets. If you look at the relationship just visually between the put-call ratio at the top and the S&P at the bottom, you can get the sense of it. Now, what I do, because it's a daily reading and it's really noisy, so this ratio will flip very quickly from up to down, and it's super noisy. So I take a 5-day average of that, just a simple average, and that's what you see is the pink line here. So that the raw data is in gray, kind of in the background. The pink line is a 5-day average, so just keep that in mind. When there's a spike in the put-call ratio, that tends to coincide with market bottoms, because that is essentially investors being, very on one side of things. Tends to be a contrarian view that they're too negatively positioned when the market goes to new lows. You can see that we're really at one of the higher levels that we've seen for the last couple of years, particularly on the raw data. Number of times over the last couple of weeks, we've had one of the highest readings that we've seen going back to February, March of 2020. So keep an eye on the put call ratio. Elevated, is it the highest it's been? Absolutely not. Could it go higher? Certainly, but certainly elevated relative to where we've been in 2022. We need to wrap the show and go to the 3 and 3. These shows go so quickly, but it's a pleasure to share some charts with you. 3 charts in 3 minutes. Let's get to it. Here's chart number 1. I'm looking at the spiders, the SPY, and I'm showing you a chart style that I call candle focus. It's just, I'm a big fan of candle charts. I don't use them on my day-to-day charts because they're a little more short-term, and I want to focus as much as I can on the longer-term trends. That's, in line with a lot of the clients that I'm working with. And I think a lot of the time frame that many of you, our viewers, are operating on, a little more intermediate to longer term. However, I have learned as a longer-term analyst to be focused on the message, get it whatever message you can out of the short-term market environment, because that tells you a great deal about how the short-term may be relating to the long-term trends. And while I would say the trend is still down, and on a day when we made a new 52-week low for the S&P, I would say by definition, the trend is still down. However, the bullish engulfing pattern, the bullish outside day, however you would describe this, as I was talking with Katie Stockton about in her appearance earlier today, that certainly suggests short-term rally mode from here. That lines up with the idea that we maybe have an October low. This could be the beginning of it. I would keep a wary eye on the lows from today for any of the charts that you're following, because a lot of individual stocks have that pattern as well. Chart number 2, ConocoPhillips. Let's celebrate in any environment. Stocks making new 52-week highs. When I was scanning for new swing highs and new swing lows for my premium members at Market Misbehavior earlier today, I was struck by a lot of financials and a lot of energy. ConocoPhillips COP making a new 52-week closing high today, up over 5%, 5.5% even today. A lot of other names in the energy sector, Hess, Oxy, FANG, DVN. These are all names, while not all of them made a new 52-week high, certainly rotating and pushing to a new multi-month high and a new swing high. Finally, banks. I saw a comment that the banks are already in rally mode. I don't know if I would describe the chart of JPM as in rally mode. If I'm a short-term trader, maybe you could talk today about being a rally mode, but I'm looking at the last 2 years. It feels like there's a lot that still needs to be proven for this chart to look anything but still very much in a downtrend. However, earnings start in earnest tomorrow. JPMorgan is one of the many financial stocks we will have reporting tomorrow. Keep an eye on those names for sure. Folks, that's a wrap for the show. I want to thank Katie Stockton joining us from Connecticut at Fairlead Strategies. Always a great take on the markets. All of our previous interviews are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.